Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about Russian oil, and specifically the impact of the production cuts that were announced initially for a period of 1 month in February, but have now been extended for the whole of 2023 on Russia's revenues. Now, the main drivers for the announcement of these production cuts in February were the introduction of the European bans on the purchase of all seaborne crude oil that was introduced on December the 5th, and on the purchase of all seaborne refined oil products, which was introduced on February the 5th, and also the associated price caps of $60 per barrel for crude products and $100 per barrel for refined products. However, President Putin, during a recent interview on Russian TV, stated that the production cuts were a direct measure to increase the price of Russian oil to try to maintain their profit margins. So in today's episode, I want to dig down into the details of this issue and evaluate exactly what the impact of the production cuts and the price falls that we've seen in the international oil markets have been on Russia's revenues. So we'll go through the details of the production cuts that Russia has announced. We'll have a look at what OPEC Plus has been doing. And OPEC Plus is an organisation that has 24 of the largest oil producing countries in the world. And they've also announced production cuts. So we'll have a look at the details on that. We'll then have a look at what's been happening to the price of oil and specifically what the impact of these production cuts has been. We'll then go on to look at what's been happening with the price of Russian oil because, as I'm sure you're aware, Russian oil is still trading at a discount. And then we'll go on to evaluate the exact impact on Russia's revenues of the combination of the production cuts and the fall in oil prices that we've seen. And then finally today I'll wrap up with my summary as to what I think the overall impact will be on Russia's economy and the global economy. On the 10th of February 2023, Russia announced that it was cutting its oil production by 500,000 barrels per day as a direct result of the sanctions being applied by the West. At the time of the announcement, Russia was producing around 9.5 million barrels of oil per day, so this cut represented around 5% of their total production. And at the time of the announcement, Russia stated that this production cut would last for 1 month till the end of March. On the 21st of March, Russian Deputy Prime Minister Alexander Novak announced that Russia would continue with the 500,000 barrel per day production cut until the end of June. And on the 2nd of April, a further announcement was made stating that the production cut would remain in place for the whole of 2023. However, contrary to the reports that Russia was cutting its production as a result of the sanctions, President Putin has now spoken on Russian TV advising that the reason for the cuts is to maintain prices. Speaking at a televised government meeting, Putin said the situation on the global oil market was, on the whole, absolutely stable as Russia maintains output cuts to support prices. He went on to add that our actions, including those related to voluntary production cuts, are connected precisely with the need to maintain a certain price environment on world markets, in dialogue and contact with our partners in OPEC+. Which is a very interesting statement because Saudi Arabia, which is one of the largest countries in OPEC, as well as the other OPEC members, have repeatedly said that they are not targeting a specific price for oil, which countries such as the USA have accused the group of unlawfully trying to do. And one noteworthy issue with regards to the price of Russian oil is that Reuters have recently published calculations showing that Russia's Urals oil blend fell in early May to 14% below the break-even level assumed for this year's federal budget in Russia. Now, before we go on any further today, I want to talk to you about today's sponsor, Galaxy Lamps. If you're looking for a unique, amazing present, or maybe even just to treat yourself, then you really need to check out Galaxy Lamps' amazing range. Now, I have one of these Galaxy Lamps and they are super cool. They instantly create a vibrant atmosphere in any room and can brighten up your party or create romantic and chilled atmospheres and are even perfect for helping you get to sleep. Galaxy lamps are really quick and easy to set up and will provide incredible results that will amaze your friends and family. And the fantastic news is that Galaxy Lamps are offering Joe Blogs viewers a 15% discount on any purchase. So why don't you treat yourself today by clicking on the link below.
OPEC Plus, the Organization of Petroleum Exporting Countries and its allies, including Russia, announced Sunday it was cutting output by more than 1 million barrels a day starting next month. That's in addition to the 2 million barrel a day cut the group announced in October, which continues at least through the end of the year. Word of the additional cuts sent oil prices soaring by more than 5% on Monday. Analysts and traders said the move by OPEC Plus could push oil prices towards $100 a barrel, setting the scene for another clash with the West grappling with higher interest rates. The decision also signals unity within OPEC Plus, despite Washington's pressure on its Gulf allies to weaken their ties with Moscow.
OPEC, which stands for the Organisation of the Petroleum Exporting Countries, was founded in Iraq in 1960 by Iran, Iraq, Kuwait, Saudi Arabia and Venezuela. These countries were later joined by Qatar in 1961, Indonesia and Libya in 1962, the United Arab Emirates in 1967, Algeria in 1969, Nigeria 1971, Ecuador in 1973, Gabon in 1975, Angola in 2007, Equatorial Guinea in 2017, and Congo in 2018. However, Ecuador, Indonesia and Qatar have subsequently terminated their membership, which means that OPEC today has 13 member countries. And these 13 countries represent around 35% of the global supply of oil and 82% of the globally recognised reserves. And alongside the official OPEC countries are another group of countries, and when they're added to the OPEC countries, this is referred to as OPEC+. And these countries are Russia, Kazakhstan, Azerbaijan, Mexico, Oman, Bahrain, Brunei, Malaysia, South Sudan and Sudan. And collectively the OPEC Plus countries account for 55% of the global supply of oil and over 90% of the identified reserves. So this represents a very powerful group of countries in terms of the supply of oil globally. And whilst the members of OPEC have gone to great lengths to state that their production cuts have nothing to do with price controls or trying to manipulate the price, very simple economics tells us that when you cut the supply of something that is in strong demand, that will generally mean that the price goes up. This chart shows the movement in the price of Brent crude oil over the course of the last 5 years. And the reason I wanted to go back 5 years is to give you a better understanding as to what's been happening with oil prices over the long term and why the OPEC Plus nations are now looking to cut production. And if we start off by looking at what happened in 2019, which was the last full year that was not impacted by the global pandemic or the war in Ukraine. At the start of 2019, a barrel of Brent crude oil was trading for around $55. Prices hit a peak of around $75 in April of that year and ended the year at around $68. In 2020, when the COVID-19 pandemic struck all around the globe and we saw cities all around the world going into lockdown, businesses closed their doors, airlines stopped flying, public transport stopped, people were told to stay at home. So this was an all-time low in the demand for oil. And in April 2020, the price of a barrel of Brent crude oil dropped to less than $20. By the end of 2020, lockdown restrictions had started to be lifted in a lot of countries, and by the end of the year, a barrel of Brent crude oil was trading for around $53, which is similar to the price that it was trading at the start of 2019. During the course of 2021, more and more countries released their COVID-19 restrictions, and we saw a huge wave of pent-up demand. Everybody that had been forced to stay at home wanted to come out and do things and buy things, and so we saw the price of oil rising rapidly, and by the end of October, a barrel of crude oil was trading for around $87, which was actually the highest price that oil had traded for more than 3 years. The price of a barrel of oil ended 2021 at around $75, and then at the start of 2022, concerns started rising about the potential for Russia to invade Ukraine because Russian troops were massing along the border. Russia's subsequent invasion of Ukraine started on the 24th of February, and the initial reaction in the markets was that the price of oil skyrocketed. And in early March, a barrel of crude oil was trading for $130. The price of crude oil stayed up around $100 per barrel for the next 3 months, hit another peak of around $120 per barrel at the start of June. However, since that time, we've seen a steady reduction in the price of oil, and it's now trading somewhere in the region of $75 per barrel. Now, normally when I'm talking about oil on the channel, we're talking about it as a consumer. We're discussing the fact that when the price of oil is high, that's bad news for everybody because the price of oil feeds through into so many different parts of society. However, for the purposes of this discussion, I want you to turn your mind to being an oil producer. If you're sitting on large volumes of oil, it's actually good news when the price starts to rise because that means that all of your assets are worth more. When the price goes up, you're earning more per barrel of oil than you were when the price was lower. So the rapid increase in prices following Russia's invasion of Ukraine was actually good news for the majority of OPEC+. The only country that it wasn't good news for was Russia, because they were having to sell their oil at a discount in the international markets to get away from all of the sanctions issues. So if we now focus on what's been happening over the last 12 months, the continued decline in the price of oil is actually bad news if you're an oil producer, because that means that you're selling your oil for a lower and lower price every single month. And this is the main driver why OPEC Plus have announced that they're cutting their production by 3 million barrels of oil per day, because they want the supply to contract so that prices start to go back up and they can earn more profit. These countries have huge reserves of oil which they know that they'll be selling into the international markets for the next 30 to 50 years. So they're happy to trade off volume of sales against price. They would rather sell less at a higher price than more at a lower price. So hopefully you can understand why the OPEC Plus countries are taking this action. But what I want to do now is delve into the impact on Russia, because Russia is not selling its oil at the market price. It's selling at a discount. This chart compares the price of a barrel of Brent crude oil, which is shown at the top of the graph, against the price of Russia's Ural oil, which is shown at the bottom of the graph. And as you can see, over the course of the last 12 months, and in fact since the start of the Ukraine war, Russian oil has been trading at a significant discount to Brent crude, and that discount has, broadly speaking, been around $20 per barrel throughout that period. The discount actually widened at the start of 2023 to nearer $30 per barrel when the European bans and the price caps were introduced. However, it has narrowed again recently. And if we look at this chart, it shows the volume of oil that Russia has been exporting over the course of the last 3 years. 2023 is shown by the dark red line at the top of the chart, 2022 is the blue line in the middle of the chart, and 2021 is the light red line at the bottom of the chart. And the scale on the left-hand side of this chart is in millions of tonnes, and there are roughly 7.5 barrels of oil in a tonne. So if we start off by looking at the volume of oil that Russia was exporting at the start of 2022, you can see that that was 3.5 million tonnes per week, which equates to around 3.6 million barrels per day. So the first thing that I'd like to do is evaluate the impact on Russia's revenues of the discount that it's having to apply in the international markets. And as we just saw on the previous graph, it's roughly around $20 per barrel. So on the basis of 3.6 million barrels per day, that equates to around $72 million per day of lost revenue through the discount, which on an annualised basis of 365 days equates to $26.3 billion. That's the direct impact of the discount at the start of 2022. However, if we now look at the latest volume figures for 2023, Russia is currently exporting around 4.5 million tonnes of oil per week, which equates to around 4.75 million barrels per day. So the $20 discount equates to around $95 million of lost revenue per day, which on an annualised basis is around $34.7 billion that Russia is losing as a result of having to sell its oil at a discount. So that is a really chunky number for Russia to have to take on the chin. But the situation is actually worse than that, because the price of oil in the markets has fallen significantly over the course of the last 12 months. In June 2022, Russia was achieving a sales price for its oil of around $100 per barrel. Today, the sales price is $57, which represents a year-on-year reduction of around $43 per barrel. And if you apply that price reduction to the 4.75 million barrels of oil that Russia is selling per day, that represents lost revenue of $204 million per day. But on an annualised basis, that equates to $74.5 billion. So you can see why President Putin is so annoyed by the fall in the price of Russian oil, and why he's trying to justify the production cuts by stating that it's a way of increasing the price. So what's the summary and conclusion today? Well, I wanted to post this video because the supply and demand of oil is one of the biggest issues that impacts everybody. We are all dependent on oil in some shape or form. And as we've seen from today's analysis, the price of oil over the last 3 years has been really up and down. We saw prices come down significantly at the start of the COVID pandemic. However, following the end of that pandemic and the subsequent invasion of Ukraine by Russia, we saw prices rise to levels that hadn't been seen for a very long time. Those prices peaked in the summer of 2022, and since that time, we have seen a steady decline in oil prices. So normally at this stage, we'd be talking about the falling price of oil being a positive thing for the global economy. However, in this video today, we've been talking about the oil-producing nations, and obviously those countries want to protect their valuable asset. They don't want to have to sell their oil at a reduced price, and as a result of that, OPEC Plus announced that they were cutting their production. Now, these production cuts were completely independent from the cuts that were made by Russia. The main driver for the production cuts in Russia were the sanctions that were being applied against Russian oil, because Russia was struggling to be able to find enough markets to sell its oil into. And as we've discussed before on the channel, if you're an oil producer, once you've got to the point where you're actually pulling the oil out of the ground, you don't want to interrupt that flow, if at all possible. And Russia doesn't have anywhere to be able to store all this oil. So if it can't find buyers, the only other option that it's got is to cut back on its production. And that's exactly what happened in February. Russia couldn't sell enough of its oil and therefore had to stem the flow. However, as the OPEC Plus countries have decided to cut back to bring up prices, President Putin has now come out and stated that the reason that Russia is cutting back on its production is to bring prices back up. However, as you've seen in today's video, that isn't working. We're not seeing a major turnaround in oil prices. We haven't seen the price of Russian oil suddenly rising back up towards $100 per barrel. In fact, since the production cuts were announced, the price of Russian oil has actually fallen. So even if there was a master plan strategy to cut production to bring up prices, it isn't working. And what I wanted to do in today's video is really delve down into the numbers and have a look at what the impact of both the discounts that Russia is having to sell its oil at and also the reduction in general market prices is having on Russia's revenues. And as we discussed earlier, at the current volumes, Russia is losing around $35 billion in terms of the discount that's being applied. But in terms of the fall in the market price, those losses are somewhere in the region of $75 billion. So when you combine the impact of both of those, the Russian economy has taken a direct hit of around $110 billion. And as you've seen from the analysis that we've looked at today, the production cuts both by Russia and OPEC Plus haven't had the desired impact. We're not seeing oil prices rising dramatically, so there is a real potential that more production cuts could be on the way, and that will have a further negative impact on the Russian economy. So hopefully you've enjoyed today's episode, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.